Proceeds from Kenya's debut Eurobond have been wired to the Central Bank of Kenya, as we said earlier. And this does set the stage for the rollout of infrastructure projects as well as relief to local borrowers. Here's Adelaide Changole to explain that.
After more than 6 years and 3 false starts, Kenya has finally listed the long-awaited $2 billion debut sovereign bond, the largest ever placement by a first-time African issuer.
The total issue of $2 billion with a weighted average interest rate of 6.6% closed yesterday, the 24th of June 2014.
The issue received 500% of a subscription to the tune of about $8.8 billion compared to the figure of $1.5 billion that we were looking for.
The bond will be split into a 5-year, $500 million tranche that will attract an interest rate of 5.875% and a $1.5 billion 10-year tranche attracting an interest rate of 6.875%. This is significantly lower than the 8.5% yield on the Ghanaian 10-year bond, something President Uhuru says is a sign of confidence in Kenya's economy.
The macroeconomic indicators demonstrate that the underlying economic fundamentals of our country remain sound, and indeed will continue to strengthen with coherent economic strategy that we are now implementing.
The Eurobond, which will now be the benchmark for Kenyan firms seeking funds from international markets, will be used to retire the $600 million syndicated loan, finance infrastructure projects, and plug the 342 billion shilling budget deficit. The funds will also reduce government appetite for local funds, leading to lower interest rates and providing much-needed credit to private sector players.
Our plan to access international capital markets, we will reduce our recourse to domestic borrowing. Consequently, the government will review downward domestic borrowing plans for the next financial year.
But the government is going even further as it seeks to reduce lending rates to below 10%. For starters, it is promoting full disclosure of bank charges through the annual percentage rate pricing mechanism to help borrowers make informed decisions. The rate requires banks to disclose all costs associated with the loan, including the repayment schedule, the interest rate, bank charges, and fees. Banks will also be required to use the Kenya Bank's reference rate that will be set by the central bank. The rate will be computed as an average of the central bank rate and the 91-day treasury bill rate, with banks being allowed to add a premium based on the bank's cost of doing business and the borrower's credit profile. And as the country looks forward to enjoying the fruits of the bond, the government is already planning to tap the international market with other foreign-denominated bonds.
We are going to diversify. Maybe not necessarily the Eurobond. We may look at other products like the Sukuk bond, diaspora bond, or other denominations.
$2 billion sovereign bond has finally been listed and the money deposited into Kenyan accounts ready to fund those crucial infrastructure projects. But all eyes will be on the government to see how well they utilize these funds to avail much-needed services to Kenyan people. Adelaide Changole, KTN Business.